PepsiCo Inc., ticker symbol PEP, is currently trading at $152.70 a share. It's recently increased about 6% after their most recent earnings that we're going to be going through. This is their fourth quarter and full year 2024 numbers. But if we go back to the stock price over the last year, it has had a recent decrease of around about, well, you can see 18 to 13%. Start of the year was trading, or this is in May, sorry, was trading at $181 a share. It's decreased about 15% since then. So can this stock get back to those numbers? If we go to the 5-year chart, its all-time highs were in May of 2023 at about $200 a share and is about 21% down from those highs. So what we're going to be doing today is quickly running through their fourth quarter and full year earnings for 2024, and then going to my automated stock valuation spreadsheet, seeing if Pepsi is a buy or a sell using the discounted free cash flow model, comparable company model, dividend discount model, and the Ben Graham formula for intrinsic value. So we'll just, we've already got, well, I'll do it again. Yeah, we'll put in the ticker PEP. This loads up all the latest company financial data, so you can see it all here. We'll go through that, then we'll look at the earnings. So $153 a share, $210 billion in market cap, P ratio of 22.1, which is lower than the market average that's 30. Earnings per share, $6.95, and a beta of 0.054, meaning it is a lot less volatile in the market. Analysts still say it's a buy, $163 or $164 a share. Now this is a dividend payer, 3.53%, meaning you'll get paid $5.42 a share. Is it a safe dividend? Yes, you can see it. It's borderline not, to be fair. 103 on the free cash flow rail, but yes, this has been a historically safe dividend. And you want to get paid by before the 7th of March to get paid your dividend. So we have the numbers here. You can see, ignore the trailing 12 months, we'll look at 2024, 91.85 billion. And if we go back to the earnings here, we can see it all here. So let me just scroll a bit down. Scroll. Keep on scrolling. So much scrolling. So we have the year ended, and then we have the quarter ended as an audited. You can see revenue. This is 23 versus 24. Down slightly, but if we look at the full year, it is up 91.4 to 91.8, which is what we have on the sheet here. If we scroll down again, we can see that the different breakdowns of this. This is breakdown between Frito-Lay North America, Quaker Foods North America, PepsiCo Beverages North America, Latin America, Europe, Africa, Middle East and South Asia, and Asia Pacific, Australia, New Zealand and China region. And we have 23 versus 24 as well. So the largest segment is the PepsiCo America Beverages, and that is down slightly, as you can see here, but pretty close. Latin America is down slightly. Europe up about 200 million. Africa, Middle East, South Asia up. China up. Frito-Lay North America down. Quaker Foods down slightly, which you can see here they are down ever so slightly. But on the full year, you can see that they are up ever so slightly, with PepsiCo Beverage America being up. So they have increased, but relatively flat. But that's what we want to see. We want to see them trending in the right direction, which they are now. Obviously, it's kind of stagnated these last 2 years, but overall, it is trending up. So some big years ahead. Net income, are they profitable? 9.58 billion. So they've managed to generate more profit, increase their income, their net income percentages from the prior years, down from 2018, which looks like their all-time high, but steadily increasing over the last few years. So if we do go back to here, this is the operating profit. And I won't go through all the numbers here, but we can see it has increased. Main example is Latin America, Europe going from minus 400 to 450 in the green. Everything else is kind of down slightly. And if we go the full year as well, they are up 11.9 to 12.8 billion. So free cash flow, 7.2 billion, down from the prior year. And if we look at operating cash flow versus capex, CapEx has been increasing, but operating cash flow is down in the last year. So you can see here, CapEx, in fact, actually decreased from last year, but operating cash flow decreased more, which is why the free cash flow is down. Shares outstanding, on the buying back their shares. Historically, yes, we can see they've been flat over the last few years. So let's have a look at the discount free cash flow model. Where is it? It's over here for some reason. Let's put it back there. This is a way of valuing stocks, looking at their future free cash flows and discount them to today's value. So currently puts at $206 a share. Let's see if we can agree with those numbers. We're expecting 96 and 101 billion in the coming years in terms of revenue. Yahoo Finance at night. 91 and 95. So they're expecting a little bit less. Let's bring this down. Oh, let me just check those dates actually. One sec. Because they're expecting Yeah, current year, oh no, fine. So they're expecting flat for this year and increase of the next year. We'll bring this one down. We'll just say this is even about 1% growth, still $176. Net income margins, they've been historically about 10%, but they have increased them ever so slightly. So I'm happy with this. And free cash flow to net income, I'm pretty happy with this number as well. So $176 a share, even if we increased the weighted average cost of capital a little bit, but theirs is quite low with 5.8%. So discounted free cash flow model does say it is a buy. If you're interested in this sheet, please check my Patreon. It's the $4 tier. This will give you access to the sheet and all the data as long as you are an active Patreon or patron. Dividend discount model, does it like it? You can see that if they increase it at about, well, anything over 2.3%, it is a buy, and you can see Pepsi has historically increased its dividends much more than that. Ben Grimm, formula for intrinsic value, I don't think it's going to like this. I don't expect Pepsi to have 18% growth in the next few years. Analysts say about 6%. We'll go 6.5%. That's because the bond yield is very high at the minute. AAA bond yield, or AAA corporate bond yield, 5.46%. If this was to decrease to, it would have to get under 2.5% again, and then it would be valued on this. So Ben Graham doesn't like a lot of stocks at the minute. So finally, let's have a look at the comparable company model. This is where we're valuing stocks, looking at their competitors, and we'll be looking at the revenue growth rates, EBITDA, net income, profit margins, price to sales, price to book PEG, and then specific metrics for the model are EV to revenue, EV to EBITDA, PE, and forward P. So I think their most closest rival, of course, is Coke, or Coca-Cola Company. Ticker symbol, easy for me to say, KO. Next we'll go Keurig Dr. Pepper, KDP, and we'll go with K, which is Kellogg, Kellogg Corp. Oh, we don't have it there. Let me just see what Kellogg ticker. Oh, okay. I didn't know it was called Kellanova. I didn't know that. I look like a fool now. Okay, fine, it has it here. So as you can see here, this loads up all the latest company financial data for these companies, and we can compare. Coca-Cola is the largest, then Pepsi, then Keurig, then Kellanova. When did they rename? So shocked about when did Kellogg rename? Huh. Well, 2023. I suppose I haven't looked at Kellogg's before. Maybe this is why. Revenue, most revenue, double of what Coke has and higher than everything else. Revenue growth rate, second highest, only Dr. Pepper is higher. Net income, second most profit, but actually third lowest margins. KO is the highest here. Price to sales, market average is about 3. Pepsi is below that and lower than Coke. Price to book, lower than Coke, but market average is 5. Price to earnings growth, you want this under 1, they're all above 1. Kellogg's is the lowest. EV to revenue, EV to EBITDA, PE, and forward PE. You can see it is a buy on most of the fronts apart from the forward PE, $200 a share. So it is a buy according to the comparable company model. And if we were to compare against Coke directly, $225 a share. So it does look undervalued compared to its competitors, and discounted free cash flow model also say it is a buy, but Ben Graham not so much. Right guys, thanks for watching. Please check out my Patreon if you're interested. Subscribe if you're not already, and I'll catch you guys next time.